right, digging deep into his musical history. Paul Brennan, our producer, for our next guest, Ryan Dietrich, chartered market technician and contributor to See It Market. He's based in Cincinnati, but he joins me here in the studio. Ryan, it's a pleasure. Thanks for being here.
Hey, Pimm, I'm glad to be back.
Now, I got to say that, we were just talking before you came in that you were formerly with Schaefer's Investment Research. Tell us about this new firm that you're with, See It Market.
That's right, Pimm. See It Market is a website currently that has various contributors that write all types of things about the market for the average investor. Really, we cater to any type of investor, but, from budgeting to the stuff that I do, talking about the markets and strategies, there's just a lot of neat things that we have going on there. And then hopefully currently sometime this fall, we're going to come out with some premium research that people can pay for and kind of get more ideas. So it's a neat startup.
Okay, so Ryan, tell us, what does your research tell you now? Let's start with the concept of seasonality and whether there is any near-term concern.
Sure, Pimm. When you talk about August and September since 1950, they are the only 2 months back-to-back that actually have a negative return. So right there, that's concerning. And you look since 1980, this is kind of neat. If you look at the average negative months, August actually is the most down on average. So in other words, when it's down a lot, down 4.66%. Now, you look back, 1990, you had the Iraq-Kuwait thing, 97, Asian contagion, 98, the Russian issues in 2011.
You could just play this all over again, right?
Yeah,
it's a little bit of deja vu.
Exactly, and that's interesting. Now we're in August again, and look what's happened today. I know we're almost flat if you look at the S&P, but the wild intraday activity because of geopolitical concerns. Now, why does it always happen in August? That could be random, but the other factor of August, let's be honest, it's very light volume usually. So when you have that light volume, people aren't really paying attention. Then all of a sudden something happens overseas. You can get that volatility, and usually volatility is to the downside. So I'm not saying we're going to have this big sell-off in August, but there are some similarities for sure with what's going on right now.
What happens after August for the stock market?
Sure. Well, obviously, then you get into September, and September is the worst month on average historically. Now, last year, we had a big down August last year, and then pretty good bounce. So these are just, it's history, it's not gospel really, but still, September is that 1 month that concerns people. We talk about, the VIX, the volatility index, looking at percentage gains over months. August and September are two of the big months. The VIX usually has big pops, so we've seen that so far. This August a little bit. Definitely this July was one of the biggest monthly percentage moves ever. So definitely volatility is back here. That doesn't mean the market has to go down a lot. I mean, we're chopping around here, but definitely volatility could be here to stay for a few months.
Brian, how do you measure bulls and bears in this market?
Well, that's a great question. There's obviously a lot of ways to do it. One of the easiest or one of the more common ways is just look at the sentiment polls, and the one thing about this market, Pimm, we just had a 4% correction like we know. The level of fear that spiked up on some of those sentiment polls was, I wouldn't say over the top, but it was very significant. The Investors Intelligence poll, for instance, had the lowest number of bulls since the February lows, for the calendar year lows. So a modest pullback.
Is that a good thing?
From that contrarian point of view, you like to see that. We had a 4% drop, and everyone gets very worried, saying this is it. This is the big one. Here comes that 10% correction we haven't had for a couple of years. And, we'll have one eventually, but as long as that happens, everyone gets scared. And that's how these bottoms continue to form. So that's kind of a bullish thing, I think.
All right, we're going to continue the conversation. We've got more with Ryan Dietrich. He is chartered market technician and contributor to See It Market. They're based in Cincinnati. Coming up, we're going to talk about presidential cycles and what that means for your investments. You're listening to Taking Stock. I'm Pimm Fox. Remember to mark your calendars next week. Listen to Bloomberg Radio, full coverage of the Jackson Hole Economic Symposium. Michael McKee, Kathleen Hayes are going to bring you news and interviews from this year's symposium, the title of which is Reevaluating Labor Market Dynamics. Coverage from Jackson Hole, Wyoming. That's next Thursday, next Friday, all day on Bloomberg Radio. This is Taking Stock. The Market Drivers Report is brought to you by Mercedes-Benz. The Mercedes-Benz Certified Pre-Owned event is back with limited-time special offers on select models. Visit mbusa.com/CPO for details and inventory today.
Markets, business, and the latest information. This is a Bloomberg Radio Business Flash. From Bloomberg World Headquarters, I'm Charlie Pellick. Good afternoon. Most stocks are falling, trimming a weekly gain for the S&P 500 index after escalating tensions in Ukraine boosted demand for haven assets. For the week, the S&P 500 index still showing a gain of 1.1%. 10-year up 17/30 seconds. The yield now 2.34%. NASDAQ higher by 4 points to 44.57. Advance there of 0.1%. S&P 500 index down 2 points, a drop of 0.1%. Dow Industrials slumping 61 points, a decline of 0.4%. Gold down $9.60 the ounce, a drop of 0.7%. Crude oil advancing $1.50 now a barrel to 97.08 for NYMEX crude. That is a gain of 1.6%. Bloomberg Sports, evening baseball, Friday night baseball, Mets hosting the Cubs, Yankees are at the Rays, Red Sox host the Astros. And Pimm Fox, that is a Bloomberg Business Flash.
Thank you very much, Charlie Pellet. This is Taking Stock. I'm Pimm Fox. I'm speaking with Ryan Dietrich. He is chartered market technician and contributor to See It Market. He's based in Cincinnati, joining me in the studio. Ryan, tell me about presidential cycles. How does market fit with the current presidential cycle?
Sure, Pim. Well, this is year 2 of the presidential cycle, and historically that's one of the weaker of the 4 years. Nonetheless, if you look at this year where we've gone so far, this point on average since 1950, it's up around 2 to 3% on average at this point of the year. And, we're up about 5% on the year so far. So this year, even though, kind of meandering here, it's still actually better than average. Now, a neat little stat also, this is year 2. If you look at the second year of the second term, so we'll just call it year 6 of the presidential cycle where we are right here, there's only been 4 of those since 1950, but the average return is actually up over 23% on average, higher every single time. So now these are just cycles we talk about, do you want to invest all the way in because of a presidential cycle? No. But the history says usually those years do have really strong last couple months of the year, and that's kind of what I think we could play out once we get through these summer doldrums here.
Tell us about equity flows. Let's follow the money. What is equity flows telling you?
Sure. Well, again, what we noticed with equity flows, like we talked about last segment, there was kind of some panic last month. In July, we saw more money pulled out of domestic equity mutual funds than any time since December 2012. We've actually had 4 straight months of money coming out of domestic equity mutual funds. So again, that's from that contrarian point of view. You kind of like to see that because, it shows there's some disbelief in the market. Now, let's be honest, though. A lot of that money that's leaving those mutual funds, it's working its way to ETFs because people are kind of taking this charge and they want to do it themselves, which I think is a good thing. But still, that kind of says there's a lack of trust in the market, and most people still have a lack of trust out there. But again, that's sometimes a good thing from a contrarian point of view.
Does the shift from mutual funds to ETFs also highlight the tax issues related to owning a mutual fund versus an exchange-traded fund?
I've never thought of it like that, but that's a really good point. I just know a lot of people, from the retail point of view at least, like the simplicity of an ETF, like doing it themselves, but there are some definite tax ramifications that could be positive also. So it's just a trend, it's a shift that we've been seeing for years, and I think it's one that's here to stay, as money will continue to work its way to ETFs over the next, probably decades, to be honest.
All right, so those are equity flows. What about flows into bond funds?
Yeah, bond funds, we've definitely seen a lot of flows into bond funds. Now, something's interesting. Everyone says, the crowd's usually wrong, but when it comes to the flows into bonds, there was money leaving bonds all of last year, and then sure enough, as January came, money started flowing into bonds, and bonds have definitely been, the contrarian play this year, if you will, where, I think it was a poll, Bloomberg poll, I think 67 out of 67 economists expected, higher rates this year. It was
didn't work out that way.
No, the year's not over, you could argue, but you're right. That is just the ultimate contrarian trade, and, look at today, 10-year continues to go lower. Who knows how low it's going to go, but there's still a contrarian trade from the bond point of view, I think, for sure.
We're speaking with Ryan Dietrich. He is chartered market technician and contributor to See It Market. Ryan, we mentioned ETFs, and I want to mention one specifically. This is the Materials Select Sector Spider Trust. The symbol is XLB. We're talking about chemical companies, construction companies, packaging corporations. What attracts you to XLB?
Sure, Pimm. Well, when you look at XLB, first off, the price action's been pretty strong. Now, there's also under the surface, we like to dig a little deeper. Look at the China market, like the FXI, the Chinese ETF. That actually, well, no one really trusts the Chinese data. I'll agree there. But that's been doing really strong. And there is a strong correlation with kind of the material names. I also like steel and coal. Some of those areas, when China's doing well, that's a neat play. And from a sentiment kind of point of view, coal specifically has done horrible for a long time, I'll admit. But, KOL's, that coal ETF, it actually just made a new calendar year high just yesterday. So there aren't too many ETFs that are making new, 2014 highs. So that's quietly, finally, after lagging a long time, showing some leadership. And China doing well also is a good thing also for that sector.
Well, we got a couple of symbols. I just want to give them out. So XLB, that is the Spider Materials ETF.
Yes.
Currently 49.60, so XLB. And then you mentioned coal, KOL, that's the Market Vectors Coal Exchange Traded Fund. Now tell me about steel. You mentioned that, and there's a specific ETF if you want to bet on steel.
That's right, the SLX. That's the big steel ETF. And when you look at steel, it had a really good fourth quarter last year. And in the first half of this year, honestly, it hasn't done much. And then U.S. Steel just had really, really good earnings. And now the group's moving again. I kind of compare steel with what solar was last year. Solar had a huge fourth quarter of 2012. Didn't do much the first half of 2013. Then just went straight up the second half of the year last year. So, and again, from that sentiment point of view, if you look at short interest, lots of bearish shorts betting against steel names. Analysts really don't like steel names. Buy, sell, holds, a lot of sells. So if you start getting some good news like we did out of U.S. Steel here with the earnings and the group starts moving, that one could really be a surprise second half leader, I think.
Ryan, is there any industry group that you would avoid?
Yeah, I mean, small caps. I'm not saying they're going to go down, but small caps led for 13 straight years. And I think this spring was kind of it. That was the big peak for small caps leading on a relative basis. And since the spring, what have we had? We've had small caps going down, market, kind of going higher, honestly. If you look at some of the blue chips, QQQ, that's the NASDAQ 100, it's looking at 14-year highs here. So we could be looking at a potential major shift for years of big cap stocks leading and the small cap lagging, which is just how it happens. The cycles change, and I think that one's changed.
I want to thank you very much for coming in and spending time with me.
Appreciate it. Thank you, Pimm.
Ryan Dietrich, chartered market technician and contributor to See It Market, is based in Cincinnati. You're listening to Taking Stock. I'm Pimm Fox. You can follow me on Twitter at Pimm Fox. Coming up, we're going to take a look at the credit cycle in the automobile industry. Find out how you can read the tea leaves to find out what's going on in Detroit. This is Taking Stock on Bloomberg.